Suppose you're new to Forex trading and you go online to learn more. The first image that shows up is this one. So it would be very easy to get overwhelmed by the many numbers and the random bars that look like mountains. This is a Forex chart, and in this video we're going to learn how we can read it and understand it. Hi, my name is Winnie and I make Forex trading related videos especially suited for beginners. If you're new here and you're into this kind of content, kindly consider subscribing and hit that bell icon to get notified every time I drop a new video. Without further ado, let's get started. We're going to break this process down to 3 steps. The first one is identifying what these random bars are. So the red bars represent the sellers, the green bars represent the buyers, and they are what's called candlesticks. We have talked a great deal about candlesticks in a past video, and I'll leave a link in the cards above as well as in the description box below. But in this video, I would like us to focus on the size of these candlesticks. You can see from this chart that candlesticks are of different sizes, and this indicates the strength of the buyers or the sellers. So if you see a large red candlestick, it indicates that the sellers have more strength compared to the buyers. And if you see a large green candlestick, it indicates that the buyers have more strength compared to the sellers. So these candlesticks combine to what we now see them on the chart as mountains. And these mountain ranges just show the movement of price. So in a past video, we discussed how there are 3 phases of market, of price movement in the market. So we have the first one, which is an uptrend. So an uptrend is when price is moving consistently higher and higher. Number 2, we have a downtrend where price is moving consistently lower. And then we have a range or a consolidation where price does not really move in any direction. So it kind of moves up, then down, up again, down, up again, down. So it kind of like forms a range. In past videos, I have mentioned how price does not move in a straight line. So it doesn't move like this in an uptrend, and it doesn't move like this. So instead, what price does is that it moves in the form of waves. So it kind of moves up, then down, up, down, up, down in the case of an uptrend, and it moves down, then up, down, up, down, up in the case of a downtrend. So this movement here now creates another 2 main phases. So the first one is called an impulsive phase, and the second one is a corrective phase. So when you spot large candlesticks moving in one direction, this one here becomes the impulsive phase. And then what follows the impulsive phase is the corrective phase. And you can spot the corrective phase when you start noticing price is now moving in the opposite direction, and the size of the candlesticks is smaller compared to those in the impulsive phase. So in the case of an uptrend, this you can spot large green candlesticks moving on up. So that becomes your impulsive phase. And when price starts moving in the opposite direction, meaning that price is now moving lower, then it has smaller size candlesticks. This becomes the corrective phase. Again, it switches up, moves on up in the impulsive phase, down in the corrective phase, up, impulsive phase. But overall, you can see that price is moving higher and higher and higher. Now, in the opposite direction, we have a downtrend. So you can spot the impulsive phase when you start seeing large red candlesticks. So when you spot these large red candlesticks moving lower and lower, and you then spot maybe smaller size candlesticks moving in the opposite direction, meaning that they're now moving a bit higher, this becomes the impulsive phase, this becomes the corrective phase, the impulsive phase, corrective phase, and so on. So you can see that price is moving consistently lower. So one of the theories that have come up to explain this type of movement is something that is called profit taking. As you would have guessed, profit taking is something that involves taking profits that have already been made in the market. So let's say, for example, a pair like pound dollar, let's say it's trading at 1.3700, and then it moves up to 1.3800. So the buyers who are already in this trade may decide to exit their positions and then take the profits that they have already made following this movement here when price moves from 3700 to 3800. So this action means that buyers have exited the market, leaving the sellers in the market, who then now continue pushing price lower. So price moves on up, indicating buyers are in control of the market. Then when price gets to 1.3800, the buyers leave, now leaving Sasa the sellers in the market, who now push price lower. Again, it happens, maybe buyers may decide to come in at this level and then continue pushing price higher. So this now leads to the mountain ranges that you can now see on your chart. We have up, down, up, down, up, down in the case of an uptrend, and down, up, down, up, down, up in the case of a downtrend. We have understood what the mountain ranges that you see on the chart are. So let's move on to what these random numbers are. So these numbers on your right are the prices of currency pairs. We have already talked about currency pairs in a past video, and I'll have that attached in the cards above as well as in the description box below. So this brings me on to the numbers at the bottom of the chart. These numbers represent time. So if I hover over the chart, you can see how the time and the date changes. For example, in this green candle, it indicates that it developed on 17th March 2022 at 2 p.m. You can see how price changed at 3 p.m. So we can say that the Forex chart shows you how prices of currency pairs change with time. Now that you have understood what the red and the green candles are, you have understood what the mountain ranges are, as well as the random numbers on the chart. So let's now combine all this, and now let's read a Forex chart. So one of the most important things to note here is that we read a chart from left to right. We're going to see how price is going to change into different phases of the market. So we're going to start here where price moves up, a bit down, moves up considerably. You can also notice the size of the candles has changed. Now the bulls have control of this market, and this becomes the impulsive phase. Notice how the size of the candles change and the price also starts moving down in this phase right here, which is the corrective phase. Also, we have mentioned how the corrective phase it has smaller size candlesticks compared to the impulsive phase. So we have the impulsive phase, the corrective phase, the impulsive phase. But notice how the bears have now started coming in. They're almost matching the size of the candlesticks of the bulls. So we have price move up. You can see the bulls are struggling at this point. Also notice how we have this evening star candlestick pattern. We mentioned this in a previous video, and how it is a reversal candlestick pattern. So we'd be expecting, or like there's a probability that price may begin moving lower, and that's what it does. So it moves down and up. Now we have right here, the bears have control of this market. You can tell this by the size of the candlestick pattern, which is now bigger compared to the smaller size candles that was before. And price moves down in this impulsive phase, then moves a bit up. Notice also the size of the candlesticks is smaller compared to that of the impulsive phase. So you have the impulsive phase, we have the corrective phase, impulsive phase, corrective phase. but here the bears are unable to continue pushing price lower, and now price just moves in this range or the consolidation phase we have already mentioned. If you've made it this far into the video, I truly appreciate you. If you have any questions, can you feel free to leave that in the comment section below, and remember to leave a like, comment and subscribe if you haven't already, and I'll see you guys in the next one.